Okay, so we're talking about stagflation, and are we in a stagflation market? Oh my God, ladies and gentlemen, is this the beginning of a recession, inflation? What are we embarking on here as Americans? The war against the Ukraine from Russia. We have inflation going through the roof. We have boats sitting in the middle of the ocean. What's happening? Should we all start saving money in a coffee can and bury it in our backyard like our grandparents did back in the 1960s? Well, I got some news for you guys, and we have a lot of information that's just kind of circulating over the financial sector. People like Goldman Sachs, Blackstone, Yahoo News, and we're getting a lot of information coming in from a lot of large corporate advisors. And we're doing the research, we're vetting out the quality of individuals that are bringing this information to the table, and we want to know what the large corporations are doing, how the big bankers, all of the big central banks are doing, Goldman Sachs, JP Morgan, Merrill Lynch. What are these guys doing, and what do they see? What do their economists tell us? Well, I'll tell you, I've been in real estate development for well over 25 years, and we have been multi-diversified. More than real estate, I've been a business entrepreneur since the 1990s, and it doesn't matter where we were in the 1990s as much as where we are moving towards today. But what is important is how we have learned to be able to position ourselves over the course of time to take advantage of down markets and incline markets. And right now we're sitting back, and the US American people are going, what is stagflation, and are we in a stagflation market? And basically, in a nutshell, if you watch one of the prior videos, and I'll put the link below if you didn't watch my prior video dissecting the information about stagflation, I'm going to put the link in the video in the video here, and watch the other full-length video on stagflation. But basically, it's when inflation goes through the roof, economic growth is super slow, and unemployment is steady. And so most people right now are looking at real estate and real estate investing in two parallels. They're looking at it in a parallel of interest rates being high and going up, or not high yet, moving in that direction, but steadily increasing, and inflation. But the biggest problem that most people are not looking at, and the one thing that keeps us from being actually in a stagflation market, is how well we're doing with unemployment right now. That's the third vertical. Right now, earnings have been astronomical. If you look at fourth quarter earnings for 2021, they're through the roof. Record high profit levels for corporations and large businesses. Balance sheets for single family homeowners is higher than it's ever been. And what is the reason behind that? Well, we arbitrarily pumped in over $6 trillion into the US economy that was printed from a Federal Reserve during the pandemic. So we have like this $6 trillion just floating around out there, and that people are utilizing that no other country in the United States has. So unemployment is at a really good place right now, because we're only sitting at 3.6%. We thought it'd be 3.7, so we're actually lower than the expected unemployment rate right now by 0.1%. And the hourly wage of what people are making per hour is up by 5.6% just in the first quarter of 2022. So what's going to be a big predicting factor for whether we're moving towards a stagflation market or not is to see the first quarter earnings for corporate on the corporate sector. If large corporations, if their first quarter earnings show variability in their strength, then we can start seeing unemployment go up. They'll start to do corporate readjustments and realign their bottom line in regards to unemployment. So what we're going to be looking at is we're going to look at first quarter earnings for large corporations. If large corporations' first quarter earnings are depicted to be stronger than normal, which they were in the fourth quarter of 2021, then unemployment rates will stay where they are. In fact, they may even drop. So right now we have a great labor market. We have an incredible labor force in the United States, and people are earning more money today than what we've seen in parallel to inflation. So even though inflation has went up, the average person is actually earning more per hour and more per year than they were pre-pandemic. And so they've went up parallel together. And in fact, right now, earnings surpass inflation. So as long as earnings are surpassing inflation, we're not really in a stagflation market. So what are good investments? You may be sitting back and saying, what are people recommending? Where are we at? And what should we be investing in? And what's great is that I sat down and I was doing some research, and I was looking at Yahoo News, and I was looking at some of the large economic analysts, and I was also reading and looking at the research that's happening with Blackstone. And one of the big things is diversification, right? Blackstone is a big real estate REIT, and they have the largest real estate portfolio in the United States. And according to Blackstone, they sit back and say, look, US American people, we are going to continue buying single family real estate. And the reason why is because most people are only looking at it in the two parallels of interest rates and inflation. Because the labor market is still so incredible and earnings are outperforming inflation, we're going to continue buying, because what that's telling us is that there is a need for housing in America, and American people are going to buy. Housing and rooftops are super important because there's a lack thereof. And so real estate and assets are on the number one asset growth for investments that they're recommending that people invest in. The second thing is large cap dividend growth. And I like this because for those of you guys who know most real estate people stay in the real estate sector and they do not invest in stocks. I'm a little different. I like diversification, so I always invest in the stock market. But when I invest in the stock market, I look at my stocks like I look at real estate. So for those of you guys who are sitting back going, should I or should I not invest in the stock market? I invest in only dividend-paying stocks, and here's why. Because once a dividend is given by a company, that dividend is paid out whether the stock goes up and rises or it's shorted and goes down. And so what I like about dividend stocks, big companies like Microsoft, like Johnson & Johnson, big companies like ExxonMobil, Walmart, is that when they pay out a dividend, I make anywhere between 2% and 8% on my dividends, which is like my cash-on-cash return in a multifamily apartment complex, let's say. So when I put an investment out, let's say I put a $100,000 investment, and I get an 8% cap rate, an 8% cash-on-cash return, I'm making $8,000 on my $100,000. Now, same thing like a dividend. If I go in and I put $100,000 into ExxonMobil and I have a 6% dividend on ExxonMobil, I make $6,000 on that dividend, plus I also make what that stock's increases in value. That's like your that's like your internal rate of return on a piece of real estate. So when you buy it, and as the asset appreciates in value, and then if you sell it, when you bought it here and you sell it up here, your internal rate of return is where that growth is, where that curve is on the growth pattern. And the spread between where you purchased it and where you sold it, that is your internal rate of return. Same thing with stocks. If you purchase a stock down here and you have that growth, you also get paid out on your internal rate of return of owning that stock. But you also have that dividend spread. And what I also like about stocks is that you can, in a good market, you can go out and leverage the money that's in your stocks. And let's say that on average, you're making 11% annually on your stocks, which is what we make annually on our stocks on average. Last year, being an exceptional year, we made about 22%. Not normal, but still a very incredible year. We're able to pull out money at a 6% interest rate from our stocks, and we have that money continuing to work for us in spite of drawing on it to utilize and leverage, and utilize it as a loan and leverage it for a new piece of real estate. And then we're able to take advantage of those dividends and the cash on and the internal rate of return of those stocks. So I love stocks. And right now, large cap dividends are in an incredible place to invest. A couple examples that Yahoo News gave was Microsoft being one of the forerunners as an example of just an incredibly strong corporate sector that set up and took advantage of corporate growth during the pandemic. And now we're coming out, yes, today they might be at a little bit of a low, but right now showing promise for just incredible growth throughout 2022. You look at medical providers like Johnson & Johnson. They got the wrath beat out of them with the vaccine for coronavirus. But I'll tell you that Johnson & Johnson is a dividend-paying stock that is a great example of corporate leverage and how they're utilizing their growth and how they're structured currently to be able to take advantage of. So if you guys want just two recommendations, and look, I'm not a security guy, I'm not a stockbroker, but just two incredibly structured corporations that are sitting in an exceptional place that pay out dividends, Microsoft and Johnson & Johnson being two great examples of great large cap dividend growth companies right now. Another one is that people should be investing in is emerging markets. You know, a lot of international growth and a lot of emerging markets right now that people should be, there's a lot of opportunity. Right now, we weren't doing trade with like Germany for sake of example. And one of the big examples for construction materials, because of what's happening between Russia and the Ukraine, and because of the lack of supply and the increased demand of building materials, is we sit back, and this may open up doors now with more additional trades with countries like Germany. So when we're talking about emerging markets, you know, Germany and the European market's always been strong nonetheless. But we look at tertiary markets that traditionally didn't show a lot of promise and growth. Today is showing that opportunity because of what's happening with the war. So this is an opportunity for the United States and other countries to actually really pick up the pace on their production, their distribution, and be able to have more resources locally utilized, or more trade agreements with different areas across the United States and across the world, so that we could take advantage of what's happening right now with emerging markets. So as we sit back and we look at where we are economically, both Blackstone, both large corporate analysts with Microsoft, Johnson & Johnson, Yahoo News, and we take a look at nonprofit organizations like the National Association of Home Builders, and we look at reputable economic entities and how they're looking at it. We are not in a stagflation market. We are not in a recession inflation market. We are currently still in a growth market. So if you look at things based on a growth over value perspective, growth is still where it's at. The time you invest right now should be invested in growth. You know, we're growing our real estate portfolio. Some people are asking me, Jerome, how are you underwriting deals right now, not knowing what the future holds? And the future can depict a lot. I'm not going to sit here with a crystal ball and tell people that in a year from now we're not going to be in a stagflation market. We don't know that. We don't have that crystal ball. All I know is that there is going to be some market compression coming in the future. When that is, I don't know. Today is not the day. We're still sitting at a very good place economically, and our financial balance sheets on a residential and corporate sector are sitting better than they ever have, and they're sitting at historic highs. So as we enter the future, people ask me, Jerome, how will you deal with stagflation if it becomes an issue in 2023 or even 2024? And so when we look at how interest rates are inclining and there's an ongoing inflation is happening, we just underwrite our deals differently. For those of you guys who follow our content, most of you guys are real estate investors, and that's the reason you're here watching this. And you guys want to know, how are you in underwriting deals? How are you taking down large acquisitions? And for those of you guys who know what we do, we build single family dwellings, residential, buy land, build houses. But our large asset holdings are in buying land and building out apartment complexes over 100 units. And so when you think about the undertaking financially that is as a company, you have to sit down and say, okay, are you concerned? And so our concerns are based on the corporate decisions that we make to make sure that we position ourselves in a fashion where we're protected. So knowing that there's a parallel between interest rates and cap rates have to go up in parallel with interest rates. We're underwriting our deals right now, knowing that interest rates are going up. So instead of underwriting a deal at a 4 cap, we'll sit back and say it's probably a good time to underwrite this deal at a 5 or even 5.5 cap rate, knowing that interest rates are migrating in that direction. So that's one thing that we're doing. The second thing that we're doing is we've seen exponential growth in the single family home residential market and in rent rates. And so when we see rent rates go up exponentially and prices for multifamily and even single family rentals go up exponentially, you have to wonder, where is the limit? When are we going to hit that glass ceiling? And when we hit that glass ceiling, what's that going to do to the market? Are rents going to drop? Will they historically just stay high from here forth forever? We don't know that. And unfortunately, like I said, we don't have that crystal ball. So not knowing and not having that crystal ball, we just take these assets knowing that we've seen such an inflation and appreciation in the values and an inflation in rents. And we say, what if the market just compresses by 10% on rent rates? And so when we underwrite our multifamily deals, we take the current market value and we assume for the worst. We assume that in a year from now, 2 years from now, something in this world is going to make that compress. And if it does, and when it does, it can be as high as 10% or even greater. But let's take at least a 10% compressed market, and let's underwrite this with a 10% compression on our rent rates. And let's underwrite this with a higher interest rates. And if that project still pencils financially, and we're okay with the number that it pencils at, and the profitability looks promising where it's worth our time, then at that time, and not until that time, will we take that asset down. And so if you see what we're doing in Arizona, in Phoenix, in Tucson, in Washington, in New Mexico, in California, in all the different cities that we're doing business in, it's because we've sat down, we've underwritten these for the worst case scenario, and we've considered what could happen if stagflation is real and if it happens in the future. We don't know what it is right now, but underwrite conservatively, and if your numbers pencil, invest. Because right now, more than ever, investments in large cap dividends, real estate, and in Garth, emerging markets are the best place to put your capital and your money and invest in growth. Ladies and gentlemen, if you like the content and you want more content just like this, click and subscribe to our YouTube channel. Pound that like button. Click on the video to watch an additional video on stagflation and what it is, to learn more of exactly what stagflation is, what will put us in stagflation, and how will stagflation affect you, me, and our national economy. Click below, and I look forward to seeing you next time.